When it comes to financial improvement, security, or financial freedom, investing is one of the most powerful tools available to us. But investing is much easier said than done, because there's a long list of mistakes that everyday investors make. So in this video, we're going to talk about 5 common mistakes that could be holding you back from reaching your investing goals. Let's get started. Market timing, probably the #1 mistake both beginner and seasoned investors make. We've all heard that investing is simply about buying low and selling high, but the reality of that is anything but simple. Market timing is the attempt to predict the highs and lows of a market, usually over a shorter period of time. You make an investment when it's severely undervalued, and you hold it during its recovery, up until the perfect moment that it reaches its peak valuation. Then you sell. The mentality isn't necessarily the problem, because buying low, selling high is consistently achievable over a longer time horizon. The problem is how poor we are at predicting asset prices in the short term. I'd go as far as to say it's impossible to consistently and accurately do without serious insider information. Let's say you see a bunch of news headlines about an impending market crash and decide to sell all your stocks to avoid losses. But as you wait, and wait, and wait for the crash, the market continues to climb, and you realize your timing was completely off. And now that you're out of the market and missing out on gains, you're faced with the challenge of timing your re-entry. The hope is that you can buy back in before prices move even higher. What did you just unknowingly do? You sold low and bought high. Completely missed opportunity. And the same can be said about the opposite of that, in which you wait for the market to bottom before buying. Because at any point, the market could rebound, leaving you wishing you had purchased something. Instead of trying to time the market, focus on time in the market. By staying invested for the long term and regularly contributing to your investments, you'll not only benefit from the power of compounding, but also smooth out the ups and downs of the market. Just invest today, tomorrow, and the next days after that. A very common mistake investors make is overlooking the importance of diversification. Look, diversification is one of those words that gets thrown around in any investing conversation, but rightfully so. Diversification is a crucial step to protecting your investments. From what? From the unexpected. There's the saying, never put all your eggs in one basket, but it could be more helpful to think about your investment portfolio as a ranch. If you invest all of your money into one farm animal, you're vulnerable to the diseases, weather, and market seasonality, I don't even know if that's a word, that can wipe out that one type of animal. But if you spread your money across multiple animals, each with different characteristics and environmental exposures, you're more likely to save a portion of your investment when things take a turn for the worst. Let's say you're bullish on the tech sector and decide to invest heavily in tech stocks. The tech sector may be booming right now, and because of that, your portfolio is going to skyrocket. But what if there's a sudden shift in factors like consumer preferences and interest rates? Your entire portfolio could suffer significant losses. It's all in tech companies. However, if you had diversified by including stocks from other industries like healthcare or consumer goods, you'd have a much better chance of weathering whatever economic storm that hurt technology. And diversification isn't just about spreading your investments across different stocks, it's also about allocating your funds across various asset classes, including stocks, but also bonds, real estate, and even alternative investments like commodities. The idea is each asset class has its own risk-return profile. So by diversifying, you reduce the likelihood of massive total portfolio losses if one tech sector or asset class underperforms, due to factors only affecting that area. Investing isn't just about math and strategy. Investing comes with a wide range of emotions, from excitement and optimism to fear and panic. Very natural feelings, but also potentially dangerous ones. So the mistake investors make is investing charged by emotion. If you want to be a successful investor over a long period of time, you need to develop ways of keeping your emotions out of the decision-making process. Your decisions need to be anchored in rationality and evidence, because emotions like fear prevent you from taking action, while others like greed lead you to take unnecessary risks. Okay, imagine you're invested in a company that reports lower than expected earnings, causing its stock price to plummet, which is very common in tech, by the way. Despite knowing that the company's long-term prospects are still strong, panic sets in and you sell your shares at a loss, only to regret it later when the stock rebounds. The same can be true for the opposite situation in which you feel overconfident. Let's say the company announces a new untested technology and the market falls into the hype. As that stock rises, you invest a lot more money than you'd normally be comfortable with. You're in essence buying into the bubble created by speculation that isn't fully grounded in reality or evidence. So what happens when things don't play out, despite your overconfidence? That money is gone, and you're left hoping that the fundamentals of the business can help the stock recover. The best way to avoid letting emotions dictate your investment decisions is to have a clear financial plan and stick to it. The plan needs to be rooted in non-emotional decision making. So by setting realistic goals, ones you can reach through consistency and a long-term outlook, you can avoid being reactionary and focus on the objective. A super costly mistake investors make is overlooking the impact of broker fees and expense ratios. Because in the context of building wealth through compound interest, every dollar counts. Some common terms to be aware of are trading commissions, management fees, transaction fees, fund expense ratios, and sales loads. Among many other types, these costs can significantly eat into your assets' returns and erode that total wealth you've been trying to build. Let's say you invest in a mutual fund with a 1% annual expense ratio because it's actively managed, and that's pretty high. For reference, the S&P 500 ETF VOO charges 0.03%. A 1% fee might not seem like that much up front, but over time, that fee's impact is compounded. If you invested $100,000 in the fund and earned an average annual return of just 4% over 20 years, your investment's value will be nearly $20K less than if the fee was 0.5%. And about $30K less if the fee was 0.25%. Extend that time period to 30 years and reduce the fees to something like a VOO, and the difference is shocking. To minimize the impact of fees and other expenses on your investment returns, look for low-cost investment options like index funds or exchange-traded funds, also ETFs by the way, that are passively managed. They usually offer competitively low fees and expenses. And of course, please read the prospectus of your funds. This is where you can find all the fine print that can help you understand exactly what you're paying for. These days, there's just no reason to be paying ridiculously high costs to invest. Bottom line, don't lose thousands to fees. If quick money could be made consistently by investing in the short term, we'd all be rich. But investing is not a get-rich-quick scheme. It's a tough, arduous path that requires patience, discipline, and a long-term perspective. One of the biggest mistakes investors make is simply forgetting that. Too many people, including myself, get caught up in the excitement of short-term gains. Why? Well, because it's awesome seeing your portfolio jump in value like that. But they forget about their overall financial goals. They throw their investment plan to the side and start the unwinnable chase. The latest investment fads, market timing, day trading, options, all of it. You'll find yourself constantly jumping from one investment to the next, which is also never guaranteed that you'd be selling at a profit. But in the hopes of striking it rich overnight, you miss out on the power of compounding, The wealth building tool of staying invested in a solid position. And that's completely ignoring the fact that no one truly knows where prices are going to be in the short term. Assets that have the potential to skyrocket in price are inherently volatile, meaning that at any given moment, your short-term moneymaker could be down 75%. To succeed as an investor, you need to adopt a long-term perspective and stay focused on the plan. A clear investment plan that aligns with your objectives. Stick to it no matter what, through market ups and downs. Stay disciplined, stay patient, and you'll be well on your way to becoming rich the right way. All right, y'all, let's end this one here. 5 common mistakes to avoid if you want to be a successful investor. Trying to time the market, devaluing diversification, allowing your emotions to dictate decisions, overlooking investment fees, and failing to remember that real wealth is built over time. Avoid these, and you'll be much better off. As always, thanks for watching. Until next time, take care of yourself, and best of luck.